All right, let's get into it. Today we are diving into the most critical battleground in the market. And no, it's not on your charts. It's the one that takes place right between your ears. We're going to uncover why your mindset, not just your strategy, is the absolute key to success.
I mean, it's the million-dollar question, isn't it? You can have the most perfect strategy, the most advanced charts, and still, somehow, end up losing. So what's going on? Well, it's because the real fight often has nothing to do with your system and absolutely everything to do with your own psychology.
And this quote from the legendary trading coach Mark Douglas, it really sets the stage for everything we're about to talk about. See, the secret isn't finding some magic entry signal. It's mastering your risk and, more importantly, mastering yourself. That is the game we have to win.
So here's our roadmap for today. We'll kick things off with that 80-20 rule and why it's so important. Then we're going to look at the mind games our brains play on us, especially a nasty one called the gambler's fallacy. After that, we get super practical. We'll crunch the numbers on risk and lay out a disciplined model to control it. And finally, we'll wrap up with a powerful tool to help you win this inner game.
Okay, first things first, we have to understand the battlefield. The market is not some friendly place where everybody can win. No, it's a direct, cold, hard transfer of wealth.
Just let that sink in for a second. When you make a profit, someone else is paying for it. There's a reason a very small group of traders consistently makes money. It's because a much larger group consistently loses it. And the single biggest difference between those two groups? It's not a secret indicator. It is a deep, unwavering command of risk and money management, period.
Now, let's talk about the biggest thing standing in the way of managing that risk. It isn't the market. It's our own mind. You know, we're all hardwired with these cognitive biases. They're like mental shortcuts that can lead to some truly disastrous mistakes.
And first up is a really big one, the illusion of control. This is that sneaky belief that if we just add more complexity, more indicators, more lines on a chart, we can somehow tame the market's randomness.
This probably looks pretty familiar, right? A chart just loaded with Bollinger Bands, Fibonacci levels, pivot points, you name it. It feels sophisticated, doesn't it? It makes you feel like you've got a real edge, like you're in total command. But in reality, you're often just creating noise that gives you a completely false sense of security over an outcome you can't actually control.
Next up, we've got something called the anchoring bias. This is when your brain gets latched onto a specific price, maybe the price you bought at or the price you wish you'd bought at, and that one number just clouds all of your future decisions.
And this picture just illustrates the problem perfectly. You might miss a fantastic trade just because the stock is a few rupees higher than your anchor price. Or even worse, you might hold on to a losing trade way too long, anchored to your entry price, just hoping it'll come back, even when all the evidence is screaming at you to get out. That little mental anchor can literally sink your entire account.
Now let's zoom in on one of the most destructive biases of them all. This is a trap that preys on our desire for things to be fair and for us to see patterns where none actually exist.
So imagine this. You're looking at this chart. The market is in a super strong uptrend. You've been trying to short it, convinced a reversal has got to be coming. But no, you've been stopped out 6 times in a row. You were just bleeding capital.
So what do you do now? Your analysis, in your head, still tells you the market has to turn. After 6 losses, you're thinking, the next one, it must be a winner. So do you double down on trade number 7 to try and win it all back? Be honest with yourself. I think most traders would say yes.
And that is the gambler's fallacy in action. It's this completely mistaken belief that what happened in the past somehow influences what's about to happen next. In the market, the odds of your 7th trade being a winner have absolutely nothing to do with the 6 that came before it. This kind of thinking is one of the fastest ways to blow up a trading account because it encourages you to risk more right when you should probably be stepping back.
Okay, so this brings us to the antidote for all these psychological traps: cold, hard math. Understanding the brutal reality of losses is the very first step to protecting your capital. We call this recovery trauma. It's that shocking moment when you realize that the journey back from a drawdown isn't a straight line. The deeper the hole you dig for yourself, the exponentially harder it is to climb back out. Just look at this table for a second. The math here is incredible. A 10% loss? Okay, you need an 11% gain to get back to even. That's manageable. But look what happens when you lose 50% of your account. You don't need a 50% gain, you need a 100% gain. You have to double your remaining capital just to break even.
A 75% loss? Forget about it. You need a 300% gain. This right here is why capital preservation is rule number 1, 2, and 3.
So, how in the world do we avoid that recovery trauma? Well, we take control before the trade is ever even placed. And we do this with a professional, disciplined risk model.
This is called the percentage risk model, and honestly, it's a professional's secret weapon. Here's how it works. Step 1, before you even think about buying, you decide the absolute maximum percentage of your entire account you're willing to lose on this one trade. Let's call it 1.5%. Step 2, you figure out the risk on the trade itself, the space between your entry price and your stop loss. Finally, step 3, you just divide your max account risk by your per share trade risk. The number you get tells you exactly how many shares to buy so that if you're wrong, you lose no more than that 1.5%. It completely replaces emotion with math.
And here's a perfect real-world example of how it works. In this trade, with a 5 lakh account and a 1.5% risk rule, the maximum loss you're allowed is 7,500 rupees. The setup on Tata Motors has a defined stop loss that works out to a 5,475 rupee loss per lot. So a quick calculation, 7,500 divided by 5,475 tells the trader they can take on exactly one lot. The decision is now totally mathematical, not emotional.
Okay, so we've got a model to control our financial risk. Great. But how do we control those biases that can make us ignore the model in the heat of the moment? This brings us to our final and maybe most powerful tool.
But first, let's look at one more sneaky bias. It's called attribution bias. When a trade works out, we take all the credit, right? My analysis was genius. I'm a market wizard. But when we lose, oh, it's always someone else's fault. The system lagged. The news was unexpected. The market's rigged. We will find any reason we can to avoid just saying, I was wrong.
And the only real antidote to this kind of self-deception is a trading journal. I'm telling you, it's non-negotiable. By forcing yourself to write down your thinking before you enter a trade, you create a baseline of logic. Then when you review it later, win or lose, you strip away all the excuses and you create an honest feedback loop. This is how you find your real patterns, confront your mistakes, and truly own your successes.
And that really just leaves us with one final thought. We spend so much time analyzing charts, trying to defeat the market. But what if, after all of this, we realize the market was never the real opponent? What if the greatest battle we fight every single day is against our own impulses, our biases, and our emotions? That is the inner game you have to win.